Tax season is upon us, but crypto taxes can be confusing for many investors. Joining us now to break down the details is Shehan Chandrasekera, Head of Tax Strategy at CoinTracker. Welcome, Shehan. Thanks for joining us. So I guess what should investors, know about crypto tax obligations this tax season to start us off?
Yeah, so I guess the first thing is that crypto should be reported on your tax return. If you sell your crypto, if you earn crypto through staking, mining rewards, etc., or if you did any crypto-to-crypto trades, so if you spend cryptocurrency to buy, even small things like a cup of coffee or something like that, those transactions trigger a capital gain or loss event, which should be reported on your tax return by April 15th for the 2022 tax year.
So are your crypto treated all the same as if it's just one type of investment, or if you, is it by coin as well? I think that was the case last year. Does that still hold? And then with NFTs, does it still, is it based on the NFT, or is it on the just system in general? Like if you bought one NFT at a certain price, sold it at another, it's not a capital gains necessarily if they're two different NFTs, or what happens there?
Yeah, so IRS first released guidance on cryptocurrency in 2014, and it pretty much said that cryptocurrencies are treated as property. So up until now, that's the only classification that we have to kind of use and kind of apply the general tax rules applicable to that. But 2 days ago, IRS issued this notice saying that they're intending to issue guidance on NFTs. In that notice, IRS said that there could be some NFTs that could be classified as a collectible, like a classic car or like a gemstone or something like that. Or there could be other NFTs that may not be a collectible. It might represent an access to a certain event or like a ticket or something like that. So if it's a collectible NFT, then you're subject to collectible tax rates, which are a little bit higher than the regular tax rates. And if it's considered a non-collectible NFTs, it's pretty much subject to the same capital gain tax rate that stocks and regular cryptocurrencies are subject to. So that's a distinction that was made by the IRS in the notice that was issued a couple of days ago.
Do they specify what the guidelines are for what makes it a collectible versus? I mean, are there specific points that they have on that?
Yeah, so that's a great question, because right now they're in the phase of kind of creating those bright line rules to determine, okay, what's a collectible and what's not a collectible. In the notice, it says that until those guidance are issued, you had to do this thing called look-through analysis. Basically, you had to think about what that NFT represents and coming to a solid conclusion that if it's a collectible or not. Now, for example, in my opinion, NFTs like Bored Ape Yacht Club or like CryptoPunks, they could be very likely be considered a collectible. But until those bright line rules are issued, you had to kind of do your own analysis and figure out if it's collectible or not.
What's the most common mistake you see crypto people making on taxes?
I think there's a lot. I think there's a big learning curve behind crypto users when it comes to complying with tax returns. Like if you look at the stocks and securities, like at the end of the year, exchanges kind of give you this Form 1099, and your job is to just put those numbers into return and file it. But in the crypto space, it doesn't happen. So you had to kind of collect all the information you have that might be spread across multiple exchanges and wallets and kind of reconcile everything and report those transactions. So it's virtually impossible to do this thing manually, especially if you have multiple wallets and exchanges. So a lot of people kind of get these numbers wrong. They apply incorrect, tax rules to some of the events. And there are so many other transactions like, providing liquidity and etc. to which we don't have any clear tax guidance. So in those cases, taxpayers struggle as well.
Yeah. And with the NFTs, if you sold your NFT, it only applies when you sell your NFT, right? Because I can tell you, I got some losses on NFTs, and but I haven't sold them. I'm clinging on. So that would not be a taxable event.
So NFTs could be actually a little bit tricky, right? Because generally speaking, most of the NFTs can only be purchased by spending another coin, mainly Ethereum. So in that case, it could trigger a taxable event as well if that Ethereum has appreciated in value at the time you're spending it to get the NFT. So that's one aspect. But if you're selling an NFT, and obviously you have to pay taxes if you sell it at a profit. If you sell it at a loss, you should still report it because you can write off that loss as a capital loss, and you might be able to increase your refund by reporting that loss.
I think the key point there is you have to sell it at a loss, and I have not sold it. I'm holding on. I'm sinking with the ship. All right, yeah. Thank you so much. That was head of tax strategy at CoinTracker, Shehan Chandrasekera.